Hey there, everyone. Happy Monday, February 9th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of perfectly overcast and comfortably warm for winter kind of day here in Redmond, Washington. After spending about 9 days on the road, getting my daughter back to boarding school, visiting my folks in Cleveland, heading to Boston so my daughter could look at Boston University, and then coming back here last night. I am super done with the winter conditions. My heart goes out to all of you kind of going through some cold and some snow. It was awesome. We had a couple days of great snow and ice and freezing conditions in Boston. But man, it's good to be back home where the temps are in the 40s and low 50s. By the way, morale is pretty high here in the Seattle area after our hometown Seattle Seahawks pulled off the win. Congrats to the New England Patriots making it to the Super Bowl. As always, congrats to the Seahawks getting it done here. That's super fun. I haven't lived in many cities where we've had Super Bowl champs while we're there. It's pretty enjoyable. I'd love to do it more. Anyways, what can I tell you about the market today? I mean, nice market, right? Nice upswing. The S&P got as high as 69.80. I'm looking at the evidence here through the course of the day. Volatility remaining kind of low. Friday's nice rally. The question was, what happens Monday, right? Do we get follow through? And we certainly got follow through in terms of additional, upward movement. We continue to see technology at the top of the leaderboard, which is not something we've seen a lot recently, but we definitely saw that on Friday of last week, and more of that today with tech at the top of the return list. Breadth conditions remain remarkably strong. The advanced decline lines just keep making new all-time highs. So there's plenty of things to be encouraged about. And I think what's most encouraging is the fact that it's not hard to find a lot of charts that look really good. A number of you mentioned on the comment section on our YouTube channel, you tuned into the Super Bowl-y, the Super Bowl themed stock picking exercise I did over the weekend with Tom Boley of Earnings Beats and Grayson Rose of Stock Charts. We had a lot of fun on Saturday picking charts and debating them. We're going to dig a little bit today into airlines, which was inspired by our discussion on Saturday. Airlines, none of us, the humans in the competition, none of us picked an airline, but the Stock Charts scooter ranking, which is basically an automated process of using that quantitative model to identify stocks, picked Southwest Airlines. So I wanted to dig a little bit into the airline space and share with you what I found. That should be a lot of fun. By the way, as we bring this up, I just passed 25,000 subscribers on our YouTube channel. That's awesome. I remember starting this YouTube channel years ago. I remember being very inconsistent about posting content. And the fact that I've gotten to the point where that many people are subscribed is pretty awesome. I hope this is just the beginning. If you like what we're doing here, please keep watching. Please subscribe. Please tell your friends. Would help us a great deal. And unless you can't tell, I enjoy doing this content a great deal. And it's been a pleasure to hear from all of you as we've built this process up over time. All right, so looking at the S&P 500, here's Friday's like rip to the upside. And then, today kind of chopped around for 30 minutes and then just resumed that uptrend phase. Now, the afternoon was more sideways, sort of like once the S&P got to around 69.75, we sort of treaded water there and spent the rest of the day between 69.60 and 69.80. As I'm sure you can tell if you do the quick math, none of those amounts that I just told you, none of those values are above that 7,000 threshold. So we still wait for SP7K to be triggered, maybe as early as tomorrow. We'll see what happens. But looking at the averages, note how the Dow is flat. The Dow did get above 50,000, which is a pretty impressive benchmark to get above. Pretty impressive milestone, to be honest with you. The S&P, as we mentioned, up about 0.5%. The NASDAQ composite up just under 1%. So with the VIX down below 20, the VIX is currently down around 17 and change, and had gone above 20 mid last week. By Friday, went down to low 18 and remained below there for most of the day today. Low volatility, low VIX basically means the options market is pricing in very small percentage change in the S&P 500 and NASDAQ. The norm, given where the VIX is now, the norm will be days like this, where the benchmarks are up or down 0.5%, maybe 1%, but not much more than that. So pretty much following through what the options market is suggesting. Small and mid caps were basically flat for the day. So with technology and communication services, two of the top three sectors, this was more growth over value today, which again has been very different. That's what we saw on Friday. That's what we saw. But that's something we haven't seen for quite some time. It's been value over growth from the fourth quarter of last year, really through end of last week. So starting to be a bit of a mean reversion. I think it's still an open question whether this is a new surge in growth or whether this is a sort of a mean reversion type of move after a significant move on the other side of the ledger. Looking at the bond markets, we can see the TLT was essentially flat. Now, bonds opened pretty weak, but then traded higher through the course of the day today. So as the day went on, both stocks and bonds were trending higher, but rates generally drifted slightly lower. The 10-year yield finished today just below 4.2%. The dollar index down almost 1%, sort of a big gap down on the UUP from Friday's session. So bonds flat, stocks up, dollar down is the way that I would describe it. Commodities, pretty good. We're seeing gold surge higher to start the week. The GLD was up about 2.5%. Silver prices pushing higher as well. The SLV was up 8.3%. Now, gold and silver have both been very volatile prices in recent weeks. After making new all-time highs in January, now in February, we're getting quite a choppy experience from a technical perspective. But gold and silver both starting the week off pretty good, and apparently, I would say the chart of gold. We'll look at that in a little bit, appearing to be regaining its mojo back into an uptrend phase. Natural gas prices were lower, but crude oil prices were higher. Energy did okay today. Looking at cryptocurrencies over the weekend, Bitcoin got all the way down to 60,000. It did surge higher to touch 72,000 earlier today, currently trading around 70,450. So that's just up slightly from where we ended the day on Sunday. Ethereum prices up about 1.3%. Most of the rest of the top 10 coins were in the green today. All right, looking at the 11 S&P sectors, not bad. 7 up, 4 down. Technology, the top performer. That's something we saw on Friday, but we haven't seen that in a while. Can't remember the last time we've had technology and communication services as two of the top three sectors. But here we are. Tech was up 1.6%. That's for the XLK. Materials up 1.3%. Communication services up 1%. On the downside, both of the consumer sectors notably were negative, and discretionary slightly outperformed consumer staples. Financials down about 0.6% as well. On the worst performing sector, though, was the healthcare sector, down just under 1%, down 0.9%. Healthcare has been a choppy, frustrating area, and in the stock picking competition on Saturday, if you missed it, we each picked a team of 10 stocks. Basically, we're going to track the performance over time. But what struck me is I would argue the toughest sector to pick a stock in was healthcare, for me at least, as I'm thinking of because we had to pick at least one stock in each of like 7 different sectors. Then we could have one defensive stock. And healthcare was when we had to have at least one name in healthcare. I did not find that particularly enjoyable. It's a tough sector, and you have some stocks in there that are doing quite well, right? Some of the pharmaceutical names, right, like a Merck, in pretty good uptrends. I ended up going with a biotech stock, but that wasn't my favorite sector. Some of the sectors I feel like I wish I could have picked like 20 stocks, like consumer discretionary comes to mind. Breadth today, not bad, right? 56% of the New York Stock Exchange names were up, 41% down. On the S&P, a little more neutral, 52 to 47%. All of these are technically in the neutral range, kind of within 40 to 60%. So not a big breadth day either way, but I would say generally, particularly with large caps and on the broader New York Stock Exchange, advancers over decliners. Looking at the Magnificent Seven and Friends, a nice bounce higher for Broadcom, up 3.3%. A nice recovery from Microsoft, up 3.1%. Potentially bouncing off of that level. None of us on Saturday picked Microsoft, and I debated. I ended up going with Apple, which is down today, but thought about buying a beaten down Microsoft as a potential idea. And I said that in the end. On the microphone on camera, just to get that locked in. So if I was completely wrong and missed Microsoft, at least I recognized it pretty early. So nice update today, up 3.1%. NVIDIA up 2.5%. NVIDIA is testing resistance now, right? This is what stock that bounced off of support around 170, 172, now moving to the upper end of the range. I did grab that chart so we could look at it. I think that's an important one. Meta, by the way, up just over 2% as well. On the downside, Apple, Netflix, Amazon, all down. Apple, the worst performer, coming down after this nice surge higher. Had a bit of a shooting star candle on Friday, so pulling back a little bit there. All right, let's continue on looking at the market carpet. As a reminder, we appreciate your questions. We had a really fun mailbag episode on Friday. So if you missed that, please take some time and review that. Those are all questions that came from viewers like you in the last week. I can't tell you how much I appreciate you sharing your questions. It gives us some great content to talk about, gives us an opportunity to address some of the areas where you're struggling. Which is part of why I started Market Misbehavior in the first place, to help people get out of their own way and make sense of the markets. And if I can help you in one small way through answering a question, I'm happy to do it. So use the comment section on our YouTube channel if you have any questions about technical analysis, about particular charts or patterns or signals that you're struggling with. Nothing's out of bounds. Happy to answer whatever you put on there. Let's get to the heat map today, and you're going to notice, at least what I was immediately drawn to, is the upper left corner of the heat map. Look at all the green up there in technology, and big names like NVIDIA, Microsoft, Broadcom, all having really good days, but even further, Palantir, AMD, Oracle, all having good up days. AppLovin, these are all names, pretty good moves. I mean, AppLovin up double-digit percentages. Now, this is a name that's been a very volatile name, but why that's striking is because this is a name that's been selling off here for the last, 6 weeks, we'll call it. So a nice upside rally. Oracle up almost 10%. That's coming off of a very beaten down level. Palantir as well. All of these stocks have been absolute dogs here. It's interesting though. I mean, if you look at like the weekly chart of Oracle, this is what I'm seeing with a lot of these names. This is what sort of had me something I was thinking about with charts like Microsoft. These names have been beaten down pretty good. Oracle was at 340 in September of last year. It's down over 50%. It's down, 60-odd% from that high. So it's come down quite a bit. And it's even within the range of the not the COVID low, dear Lord, the tariff tantrum low. That's in April of 2025. I mean, we almost round tripped all the way back down to those levels. Now, is Oracle a great chart from a technical perspective? I would argue very much no. Right? I mean, it's in a primary downtrend of lower highs and lower lows. This could have, the Friday last week could end up having been the low, but I'm not seeing enough on the chart now to say that was an obvious bottoming point, right? On the daily chart, sure, we were overbought, we were oversold, but we're oversold a lot during primary downtrends. That actually happens quite commonly. So I'm looking for signs of accumulation. I'm looking for a broader rotation. I want Oracle to get above moving averages. I want the momentum to be up here above 60, representing a new influx of buying. I'm not seeing any of that yet. However, does it make sense to be buying great companies like an Oracle that has been devalued so significantly in the last 6 months? And I think that's the argument on buying an Oracle. It's not because the chart is so attractive. It's just because it's down so much. And the question is, how much further downside are you willing to experience to, play the next big move higher? On the weekly chart, by the way, one of the indicators I've learned to use for something like this is the weekly PPO. Now, it's designed to be late, right? So this indicator is not going to give you a crossover, kind of bullish crossover at the bottom. It's going to happen after the bottom once it's actually started to improve. So for me, as a trend follower, I get excited about a chart when it's in a primary downtrend, and then when the weekly PPO starts to generate a buy signal. That's where you get some of these really meaningful kind of long-term lows that can be interesting entry points. And again, it's not at the bottom. It's going to be a little bit after, but that's what I might be looking for on a chart like Oracle. And I think Oracle and Microsoft are in those like falling knife beaten down names that you could make the argument that it's gone down so much. Are you going to regret taking on a position at these beaten down levels? I mean, maybe not, right? We'll certainly keep an eye on that one. Here's healthcare. I mentioned healthcare is a frustrating sector, right? And today, some of the names that have been working, like Merck, pulling back a bit. Still great charts, still making higher highs and higher lows. I wouldn't be worried about that chart just yet, but very much a mean reversion feel to this day in a lot of ways, right? You have charts like ISRG bouncing up off of a swing low. You have charts like Merck pulling back after making a new high last week, a new all-time high. In the financial sector, I'm noting charts like MasterCard that just refuse to look good. Berkshire Hathaway stalling out at resistance. Visa struggling, maybe holding support here for sure, but really not mounting any sort of meaningful accumulation. So I think within a lot of these sectors, there's a big difference between a Goldman Sachs that I would say arguably still in a primary uptrend versus some of those other charts I mentioned that have been deteriorating quite a bit here. Final thing I would note would be within the consumer staples sector. This sector was down today. One of the 4 S&P sectors that was in the red. Charts like Walmart are still really good charts, right? Still coming fresh off of a new all-time high. I think that was last Friday. So still a good uptrend, but again, we're getting some choppiness here this week and starting the week in a position of weakness. Finally, I'm looking at the mining stocks, right? Because these were names that made new all-time highs last week, kind of choppy to down, especially going into the weekend. But we're seeing Newmont Mining, Freeport-McMoRan. Those are two of the big mining names that are in the S&P 500, both having pretty good updates here today. It's a space to watch for sure. I think that long-term strength in precious metals, I would not expect that to be over just yet, given the strength we're seeing in the chart of gold. All right, we're going to continue on looking at some charts that I've hand-selected through the course of the day today. I do want to give a shout out to one of our longtime partners, Seeking Alpha. They're actually doing a Valentine's Day sale here, I think this week into next week. So you can find out more information at marketmisbehavior.com/Seeking Alpha, or just scan the QR code that you see on your screen. Seeking Alpha is one of those platforms I use pretty regularly. I love their quant model, which is an institutional level quant model, an alpha model, which is basically looking at the characteristics of good companies and trying to find those characteristics in stocks today. So their score using multiple factors and then rolling it up into a composite score, I think is a great way of filtering through a universe and focusing on areas of potential opportunity. You get access to that along with some really good portfolio analytics, like a health score, kind of like taking your portfolio to the doctor for a wellness check, and some really good proprietary research and a lot more. So you can find more information at marketmisbehavior.com/Seeking Alpha. And again, thanks to those guys for being longtime partners. As always, when you use one of my links, gives you a little better deal than if you go directly to the site, and helps me make Market Misbehavior awesome. And I appreciate you supporting the channel. All right, so the S&P 500 back into that bullish green area as we get back above 6,900 on Friday, right? Thursday of last week, things really looked vulnerable. We had closed slightly below 6,800. It looked like that might be a really dangerous breakdown as we had closed below the 50-day moving average. But Friday, a nice bounce higher. Today, more of the same. So we're back in the green light. Things are good kind of region. Not enough to get the horn out. That's 7,000, which we have yet to close above. But I'm keeping an eye on that one for tomorrow. I may get I have the horn out over there off camera. Actually, it's on camera back to the off my right shoulder. So I may have to dust that off here pretty soon. So with the S&P where it's at, again, the S&P generally is in a sideways trend. I would describe this current trend in the S&P not as a strong uptrend or a strong downtrend. I think it's a sideways phase. I think it's a consolidation range that essentially has been in place since the fourth quarter of last year, since October. Push above 7,000 really clears the way for a nice move higher. But I would also need to see an improvement in momentum, right? Every one of these new highs or attempted new highs has seen the RSI remain in that sideways range between 40 and 60. New highs with the RSI moving above 60. I think that's the bull outcome here. We haven't seen it yet. Looking at the S&P, this is a question that I got from one of my premium members over the weekend. I just want to share with you, just some thoughts on what I call the newer Dow theory. Charles Dow, worked up a whole philosophy using the Dow Industrials and the Dow Railroads, thinking about the producers of goods and the distributors of goods. And if they're both in agreement, if both of those indexes are breaking out, that's bullish. And if one of them is breaking out and the other one isn't, that's not so bullish. It's called a bearish non-confirmation is what he called it. I think a modernized version of that is looking at the equal-weighted S&P and the equal-weighted NASDAQ 100. Those are good indexes that represent kind of the old economy and the new economy. And when they're both breaking out, I found that to be pretty good. So the RSP is an ETF tracking the equal-weighted S&P 500. The QQQE is an ETF that tracks the equal-weighted NASDAQ 100 index. I've highlighted with these red bars anytime when the S&P made a new swing high and it was not confirmed by the NASDAQ 100. What you're going to note is if you look up on the chart, you're going to find like at the end of 2021, that was a pretty good signal of a lack of confirmation, right? The fact that there is weakness in the technology and the growth space that wasn't really being reflected in the chart of the S&P. That ended up being obviously a pretty significant peak. The next 9 months were pretty painful here. The next bearish divergence you had here was in March of 2024 by my reading. It ended up being a pullback into an April low in 2024. But then some of these have not been that painful, right? We had a divergence here in July and August of 2024. We pulled back a little bit, but ended up making new highs soon after. We had another bearish divergence in summer of last year, which was a one we noted very, very openly and shared, I'm sure, on the show here. But the S&P made new highs soon afterwards. So what you have to remember is divergences like this, for me, aren't a signal on their own. They're a warning sign. They're a red flag, right? The market's telling you we are seeing similar conditions to previous tops. But then I think it goes to, am I seeing anything on the chart of the S&P that suggests that this divergence is leading to some pain and leading to some risk-off behavior in the major indexes? That's what I don't think we've necessarily seen here, like in summer of last year. We never really had that painful pullback. The question was asked because the equal-weighted S&P made a new all-time high last week, and the equal-weighted NASDAQ did not. So in the short term, it's a bit of a divergence here over the last couple of weeks. We'll see if there's a significant pullback. I think the S&P breaking below that kind of 6750 level would be a nice maybe confirmation of that short-term divergence. But for now, kind of holding in there okay. But something we'll watch. The chart of gold having a nice update to start the week. Friday, as stocks were up, the GLD was up as well. And then today, following through to the upside. So I like how precious metals are kind of returning to this uptrend move. It's obviously been a very choppy session here. Not unexpected, given the exponential rise that we saw in January. Not unexpected that we would have a severe pullback, which we did. But now we're finding this chart gain some stability. Note how the RSI didn't get much below 50 on that pullback. So even though it was a significant couple days of a drawdown, the momentum was actually quite strong still. And now we're seeing that recovery back to a pretty bullish trend in gold, I would say. Here's Bitcoin. You can see really chopping around here. Obviously a huge risk off move. I think the chart of Bitcoin is still pretty concerning here. What's interesting as I'm looking at it is Bitcoin's down 52% or so. I mean, I'm rounding, but from the October peak, just above 125,000 to this February low, right around 60,000. It's about a 52% loss from peak to valley. And again, as I'm thinking in more of long-term accounts, am I going to regret if I don't buy, going forward, would I ever regret buying something down 50% or how much lower is Bitcoin going to go? So that's not a great technical argument. That's more of a long-term cyclical argument, right? Buying something that's completely beaten down because I'm okay having some short-term pain for the long-term benefit. So this is one of those charts that I think from a long-term perspective, right? Like in a retirement account, you're not planning to touch for a while. This could be a really interesting place to take a shot. Now it's up about 10,000 points since that, touching that 60,000 level, right? So most of the time it's been spent around here, which is still down a pretty decent amount, obviously. Things that I would look for, right? Obviously, improving trend, improving momentum. Indicators like the weekly PPO giving a buy signal are things that give me confidence to take a shot at a chart like that. So from a trend following perspective, I would say the trend is still very, very questionable. Also looking at the chart of Coinbase, I'm debating this one as well, right? We've gone down quite a bit from an all-time high, just about 440. That was in July of last year to where we were last week. This is a weekly chart. We got down to around 145 on a weekly basis. That's pretty much the lows that we saw in Q1 of 2025, also Q3 of 2024. So we are testing some major league long-term support. Again, from a trend following perspective, not a lot to get excited about. This is one of those times where, waiting for confirmation from like the weekly PPO has been pretty helpful at identifying a tradable low soon after, a couple weeks after that major low, and giving you some confidence. One way to think about this, and this is where I think the technical toolkit can be so helpful. Remember, some parts of the technical toolkit are leading indicators, right? They're things to help us anticipate that we're near a low. Things that come to mind would be the RSI with a bullish divergence, which we don't see here, or oversold conditions, which we're pretty much right there. testing long-term support or moving averages, right? That tells us we are nearing a point where buyers have come in previously. Maybe that gives us a good level with which to think about risk versus reward. Maybe take a partial position when those kind of leading indicators emerge, but the lagging indicators, which confirm a bottom has played out, maybe that's where you get into something and complete that position. Something I'm thinking about. I don't have a position in coin at the minute, but something I'm looking at. All right, Amazon also gapping lower, gapping down to $200 a share. This was on Friday. Thursday we gapped lower. Friday we gapped lower again, but closed toward the highs of the days. Today, sort of a choppy doji candle where the open and close are pretty even. This is not a great chart in my opinion. This is a chart I'm not excited about until, again, we see signs of improvement. So there are a number of things like a Microsoft, like an Amazon in the growth space, big growthy names that have been bid down very, very aggressively, right? They're now valued much lower than they were when you think about the price relative to, potential long-term expectations. But is there something on the chart telling me to get excited yet? There is not. NVIDIA, however, having a nice bounced off of a support around 170. Those are the lows from November and December. We basically retested that last week. Nice bounce on Friday. Today bouncing again, really close to eclipsing previous resistance around 193. I think a break above 193, at least in the short-term time frame, exits this consolidation range and tells us new accumulation. So break above 193, RSI above 60. That would validate that breakout as well. Better volume would be encouraging also. One of my premium members asked about airlines over the weekend. I just want to share with you some charts with that theme. This is a weekly chart of jets and highlighting this to show that, making a new 3-month high last week. And this is a space that has started to improve, but not all of the airlines look like the Jets ETF. It's actually a fairly diverse space. So this is one of those where I'm probably less of a fan of just buying an ETF because I'd much rather buy some of the better charts within that group. Some of the charts that I think look more constructive, Alaska Air Group, this is the biggest carrier here in the Seattle area. This is their hub, and we can see a breakout above long-term trendline resistance, right? Take the February 25 high, the September 25 high on Friday. We finally closed above that trend line today, following up with a nice move above 60. I think that's a nice breakout. So from a trend line perspective, nice breakout. You can also remember as we're trading higher, use the lows as a way of just measuring the, visually the pace of that uptrend. So I'm taking the November low and the January low and sort of extending that trend line higher. But look how all the moving averages are sloping up. We broke above resistance around 53 and change, and now following through to the upside. Nice improvement in relative strength as well. Delta Airlines actually made a new 52-week high on Friday. Today kind of chopping around, but out of all the airlines, I think compared to others that are still underwater, this is one just breaking to a new swing high, which I think is pretty encouraging. Southwest is one that actually feels a little extended to me, right? It's had a really good run, and I think the long-term chart looks pretty good, but most likely, given the fact that we're overbought, you'd probably expect some sort of pullback and some sort of higher low, maybe a pullback to the 21-day EMA gives you an opportunity. But given the fact that we're overbought after this run higher, this is after earnings at the end of January, feels extended. So a tactical pullback may be something to look for there. We'll finish the show sharing a chart that's just in a nice uptrend. I mean, the technology sector, it's not just about the big Apple, Microsoft, semiconductor types of names. There's a bunch of other ththings in there as well. Corning, ticker GLW, is in the telecom equipment space, made a new all-time high again today. This is after gapping higher in third week in January, fourth week in January, continuing to the upside, moving averages all in the proper order, relative strength, momentum, all pretty constructive here. Even if you're bearish about the markets here, and I don't blame you if you are for whatever reason, remember, right, that a market call I don't think should dissuade you from identifying strong charts. That's why I finished every episode of the show with, it's always a good time to own good charts. I think charts like GLW are innocent until proven guilty. All right, folks, that'll do it for today. Thanks for joining me here on Monday, February 9th on the show. Please take a moment, drop a question in the comment section of our YouTube channel. We would appreciate that very much. It's been a great start to February here for the Market Misbehavior podcast. Had some really good interviews. No interviews last week because I was on the road kind of getting around, but John Kolovis of Macro Risk Advisors was the most recent episode. That was a really good one. If you follow charts, if you follow technical analysis, which I'm sure you do if you follow my work, John is one of the best out there, a fantastic technical analyst, and really did a great job of highlighting some important parts of the technical toolkit that I think you're going to enjoy. A lot of more great interviews coming up here in the days and weeks to come. In the meantime, have a great night. I'm Dave Keller with Market Misbehavior, reminding you, as always, it's always a good time to own good charts. Take care, folks.